So, usually when you get invited to perform at the biggest venue in the world, the host actually unlocks the front door for you.
Right. Yeah. You're on the marquee. You just expect to walk right in.
Yeah,
It's just the baseline expectation of how the world works.
exactly. But think about this. What if you headline a sold-out stadium, thousands of people are cheering for you, and the venue physically will not let you sell tickets at the door? Like they just lock you out of the box office entirely. Today, we are connecting the dots on this massive, really massive shift in how global commerce actually functions. Welcome to the deep dive, by the way. We are so glad you're here with us. We're looking at a stack of data that maps out, well, a few different things. The explosion of sub-Saharan Africa's digital creator economy, for one, and then the highly specific global monetization rules for TikTok.
Yeah. And we're also pulling in the staggering reality of worldwide AI adoption, which completely flips the script on what we usually hear, plus the latest autonomous payment protocols from Stripe.
It is wild. By the end of this, we're going to show you how a self-taught chef in Nairobi and a fashion designer in Johannesburg are basically perfectly positioned to explain a multi-billion-dollar shift in global payments and autonomous AI agents.
Yeah, they're the vanguard, which is a crazy thing to think about, but the data completely backs it up.
It really does.
Yeah.
So let's jump right into the cultural milestone we're seeing, because frankly, sub-Saharan Africa's creator economy is absolutely taking over the global stage right now. If you look at the 2026 TikTok Discover list, which, highlights the 50 most influential digital voices globally, we're seeing this massive, undeniable representation from the region for the very first time.
Oh, entirely. And, the caliber of the content is what really stands out here. I mean, they aren't just participating in trends anymore. They're inventing them from scratch.
Oh, it's incredible. Take Dr. Olawale Ogunlana in Lagos. He is taking these incredibly complex health topics and basically turning his smartphone screen into a modern stethoscope. Like he's reaching millions of people who might not have, consistent access to a local clinic.
Right. He's filling a massive infrastructure gap with content.
Exactly. And then there's Trevor Ware, this self-taught chef from Nairobi. He literally started cooking on his kitchen counter. And now he's heading to New York for a live culinary showcase hosted jointly by TikTok and the Food Network.
Which is a huge deal. I mean, this represents a fundamental shift. Africa is really positioning itself as an active shaper of global digital culture, not just a passive consumer of it. But, and this is the kicker, there is a profound conflict happening right behind the scenes.
Right, so wait, this is where that stadium analogy comes back in. Because TikTok builds this multi-million-dollar creator fund, right? And these creators are driving millions of views, they're keeping users glued to the app, they're driving insane engagement. But how are they actually making money from those views? Like, what's the payout?
Well, that is the multi-million-dollar question. And the harsh answer is they aren't. At least not directly from the platform itself.
Wait, seriously? Nothing?
Basically nothing. So TikTok's primary payout system for views is the Creator Rewards program. It pays roughly 40 cents to maybe $1.50 per 1,000 qualified views, but there's a very strict geographic paywall in place.
A paywall. So let me get this straight. They geofence the fund so entirely that the fastest growing continent of creators can't touch a single cent of it. I mean, that doesn't just sound like an administrative oversight. That sounds like a massive structural failure for a platform that claims to be global.
It is incredibly restricted. The program is available in Tier 1 countries, so places like the US, the UK, France, Germany, and they're expanding into places like Brazil and Japan.
Yeah.
But currently, the entire continent of Africa is excluded. Like, not a single country there is eligible to receive those direct view-based payouts.
That is wild to me. You are generating all this value, all this traffic, but you're totally locked out of the primary compensation mechanism. So how are they surviving? Like, if they aren't getting the passive ad revenue that an American or a British creator just gets by default, what are they doing with all that attention?
So this exclusion is actually forcing this massive wave of hardcore entrepreneurship. It's fascinating because they literally can't rely on passive fractions of a cent per view. African creators are leapfrogging the traditional influencer model entirely. They aren't waiting for sponsorships. They are becoming global merchants.
Ah, I see. So they just bypass the whole, hoping for a brand deal phase and just build the brands themselves from the ground up.
Precisely. You look at creators like Shiriki Hato in Nairobi. She founded Savannah Space, which is a furniture and design studio. And Tamian Nsikalelo down in Johannesburg, who runs a fashion brand called Tolthema. They aren't waiting for a platform to throw them crumbs. They're using TikTok Shop. and their massive visibility to turn viewers directly into a global customer base.
Just running cross-border businesses entirely from their smartphones. I mean, that makes perfect sense on paper. But practically speaking, to ship custom furniture from Nairobi to London or run a global fashion brand from Johannesburg, you need serious financial infrastructure. And historically, traditional banking was a massive hurdle in that region, wasn't it?
Oh, absolutely.
Yeah, like just getting a standard business checking account or processing international credit cards was a complete nightmare. So how are they actually processing these global payments today?
Well, they aren't waiting for brick-and-mortar banks to catch up either. They're leapfrogging them entirely into what the data calls Fintech 2.0. So get this. Over 79% of African adults now have access to digital finance.
Wow, nearly 80%.
Yeah, they are so much banking the unbanked as they are empowering the digitally active. It's a completely different paradigm.
And the numbers out of Kenya alone are just mind-bending here. Like, mobile connections are at 134% of the population.
Right, meaning people clearly have multiple SIM cards for different networks.
Exactly. But then internet penetration is only at 40.5%. So I was looking at this and thinking, how do you have a digital finance revolution when nearly 60% of the country doesn't even use the internet? Like, the math doesn't math there.
Right, and that's exactly where we have to look at the actual mechanics of Fintech 2.0. Because a huge driver of this is a technology called USSD.
Okay, yeah, let me jump in here because I actually dug into how USSD works for this deep dive, and it is brilliant. USSD stands for Unstructured Supplementary Service Data. And for anyone listening right now who thinks you need like a 5G smartphone and a downloaded app to do banking, USSD just throws that completely out the window.
It really does. It's so elegant in its simplicity.
Right. It's essentially this text-based communication protocol that works on any basic, totally offline feature phone. You just dial a short code like *123#, and it opens a plain text menu. You hit 1 to check your balance, 2 to send money. And it communicates directly with the telecom servers via the cellular network, completely bypassing the need for a broadband internet connection.
It is a perfect example of building specifically for the environment.
Yeah.
The digital rails were designed for the reality of the local infrastructure rather than trying to force a Western banking model that requires constant broadband into a place where it simply doesn't fit. You literally don't need a data plan to move capital.
That is huge. And it's not just the connectivity that's different, is it? It's the identity piece, too. Because, well, you can't open a bank account anywhere in the world without proving who you are.
Exactly. The lack of formal paper-based identification used to be the single biggest barrier to entry for financial services there. But now these countries are aggressively rolling out national digital IDs based on biometrics. So fingerprints, facial recognition, iris scans.
Really? They skipped the paper entirely and went straight to biometrics.
Straight to biometrics. And this acts as an instant, basically infallible, know your customer's verification. It's actually slashed identity fraud by nearly 40%. And, when you remove that massive fraud risk, it makes it infinitely safer and much, much cheaper for digital banks to operate.
Okay, let's put this together for the listener. Let's walk through a real-world scenario. Say I'm a street vendor in Lagos or Nairobi. I don't have a traditional credit history, I have zero collateral, and I have absolutely no paper trail from a legacy bank.
Right.
But I do have a digital biometric ID and a basic mobile phone using that USSD text menu. How do I actually get capital to grow my business?
You get it through alternative credit scoring driven entirely by AI. And this is where the raw data just tells an amazing story. Because you don't have a FICO score, AI algorithms analyze your mobile habits to build a highly accurate risk profile.
Wait, my mobile habits? Like who I call?
More like your transactional habits. How often do you buy airtime? Do you pay your utility bills on time to the USSD menu? What are your e-commerce transaction patterns? Like who are you consistently sending money to?
Wait, really? So an AI algorithm looks at the fact that, say, I consistently top up my mobile airtime every Tuesday for a year, and based on that behavioral data alone, it decides to give me an instant collateral-free business loan.
Yes, exactly. Because in that specific economic context, that data point proves consistency, cash flow, and reliability just as well as a traditional tax return might in the US or Europe. And this is scaling massively right now. Micro, small, and medium enterprises, MSMEs, account for 60% of employment in sub-Saharan Africa. Platforms are using this alternative data to issue instant automated credit to these businesses, bypassing the loan officer completely.
That is incredible. So that totally solves the local capital problem. But what about the cross-border issue? Because our creators from earlier, the designer and the furniture maker, they are trying to sell globally. And cross-border fees used to be absolutely brutal.
Oh, they were the most expensive in the world, often 8 to 10% per transaction just to move money across a border.
10% just in fees.
Yeah.
That eats your entire profit margin.
Exactly. And this happened because the funds had to physically bounce through legacy correspondent banks in London or New York before reaching their destination in, like, a neighboring African country.
Yeah.
It was wildly inefficient. But now they are integrating blockchain and this new system called the Pan-African Payment and Settlement System, or PPS.
Oh, I read about PPS. It's a game changer.
It really is. They are bypassing the Western correspondent banks entirely, which is dropping those fees from 10% down to under 3%. They aren't just catching up to the West, they're building a highly efficient track from scratch.
Okay, so AI is being used behind the scenes to issue these microloans based on phone habits. But looking at the global data from our sources, that is just a tiny, tiny fraction of the AI story, because global AI adoption is happening so much faster and in completely different geographic centers than what we typically assume.
The numbers are just staggering. Over 4 billion adults, which is about 81.2% of all online adults globally, use some form of AI monthly now. And standalone generative AI platforms alone already have 2.42 billion users.
Right, but here's the stat that completely caught me off guard. When you look at the ranking of countries by AI adoption, the United States is sitting at 71.5%. The UK is at 62.8%. Guess who is number one in the world?
It's not who you'd think.
Not at all. Kenya. Kenya is number one globally, with a massive 97.5% of online adults actively using AI. I mean, why is that? Why is a market like Kenya adopting this at a rate that absolutely crushes the US and Europe?
It really comes down to utility versus novelty. In Western markets, AI was largely introduced as a novelty or maybe a marginal productivity hack, like writing a quirky email, generating a funny image, or just summarizing a long meeting.
Yeah, like a fun toy you play with when you're bored at work.
Right. But in a market like Kenya, users are adopting it out of sheer economic necessity to bypass those broken legacy systems we just talked about. They're using it to establish creditworthiness, to instantly translate complex cross-border trade documents, or to access medical triage information when local doctors are scarce.
That completely reframes the psychology of the user. Think about how you or I might use AI right now. You might ask it to, I don't know, plan a vacation itinerary to Italy. But for these global creators and entrepreneurs, it's literally a foundational survival tool for their business.
Precisely. And when surveyed, the top use case globally at almost 59% is simply finding information. It's being used as a highly practical enhancement to daily life. And honestly, the fears surrounding AI reflect that grounded utility perfectly.
Yes. I loved this part of the data. The existential dread, the whole Terminator scenario where AI becomes self-aware and takes over the world that was dead last. Only 6.7% of people listed that as a primary fear. What people are actually terrified of is unreliability. Over 26% are worried about AI hallucinating or giving bad information. And another 22% are worried about the economic impact and job displacement. They are worried about their livelihoods today, not some sci-fi apocalypse tomorrow.
It shows a very pragmatic, working-class relationship with the technology. People expect it to work accurately because they are actively building their real-world businesses and financial futures on it.
That makes so much sense. But okay, I need to play devil's advocate for a second here, because the sources threw a brilliant contrarian stat at us that we have to talk about. We have all this hype, all these billions of dollars pouring into generative AI startups every single week. Yet Yahoo, a website launched in January of 1994, still gets more monthly web traffic than ChatGPT.
I mean, it's a crazy statistic.
Right. Yahoo gets 5.7 billion visits. ChatGPT gets 5.53 billion. So my question is this AI revolution just a shiny new toy that hasn't actually managed to beat a 30-year-old search portal? Are we completely overestimating this?
It's incredibly easy to look at that one specific metric and think, oh, the hype is completely overblown. But we aren't overestimating the shift. We are fundamentally misunderstanding how the shift is actually happening. AI isn't just a destination website you visit anymore.
Well, like going to a specific URL just to type a prompt into a box?
Exactly. AI is becoming invisible. It is the foundational infrastructure layered behind the scenes of the apps and services we already use every day. It's the engine analyzing the mobile airtime for that street vendor's loan. It's the adaptive pricing algorithm determining local currencies for a creator's storefront. The direct traffic to an AI chat interface is going to be completely eclipsed by the invisible automated actions AI is taking on our behalf across the entire internet.
Okay, let me pull this thread then. Because if AI is becoming the invisible infrastructure, how does that connect back to our TikTok creators in Nairobi and Johannesburg? Like, if they are building global businesses because they are locked out of ad revenue, how is this invisible AI going to help them actually process global payments and manage their storefronts without needing to hire a massive human operations team?
Oh, this brings us directly to Stripe's 2026 sessions announcements. This is where it all clicks together. They unveiled the Agentic Commerce Suite and the Machine Payments Protocol, or MPP. They are literally, right now, building the economic infrastructure for AI to transact.
So, wait, we aren't just talking about a human using an AI chatbot to write a clever product description for their website anymore. We are talking about AI agents actually doing the buying and selling themselves.
Yes. An AI agent can now autonomously program and execute microtransactions. They can use what Stripe calls Link's Agent Wallet. They can actually negotiate prices, check inventory balances in real time, pay invoices, and transact globally using stablecoins.
Hold on. For those listening who haven't fallen down the crypto rabbit hole recently, let's explain the stablecoin piece really quick because it's crucial here. A stablecoin is essentially digital money that is pegged to a traditional currency, usually the US dollar, so its value doesn't wildly fluctuate like Bitcoin or Ethereum.
Right, it stays steady, hence the name.
Exactly. So instead of a payment bouncing through 3 different international banks, racking up all those conversion fees we talked about, and taking 5 business days to clear, it moves from one digital wallet to another instantly over a blockchain. It's basically like handing someone a physical digital dollar bill across the globe.
That's the perfect way to look at it. And Stripe has effectively given AI agents the ability to hold those digital dollars. They can seamlessly interact with other AI agents or human merchants over a universal API handshake.
Okay, I need a metaphor to ground this because honestly, it sounds slightly terrifying if you don't fully understand the mechanics. Think of Stripe's new protocol less like a standard digital wallet and more like giving your AI assistant its own corporate credit card.
That's a great analogy.
Right. It can book the flight, pay the vendor, do all the complicated machine-to-machine handshakes in the background. But, and this is the big question, who holds the bag if my AI goes rogue? Like, what if it hallucinates, gets confused by a weird prompt, and buys 1,000 decorative pillows from that furniture maker in Nairobi? How much control do we actually have over these autonomous agents?
See, that is the exact fear of unreliability highlighted in those global surveys earlier. People are worried about AI making expensive mistakes. And Stripe knows this. That's why they build very strict, highly programmable guardrails into the infrastructure. It is definitely not an unchecked free-for-all.
Okay, so how do those guardrails actually work in practice? Like, how do I stop the 1,000 pillows?
So as a user, you assign specific agent identities and you enforce strict scope rules. You can set hard spending limits. So like, don't spend more than $50 without asking me. But most importantly, for any consequential actions like massive inventory purchase or a major funds transfer, the system requires human-in-the-loop confirmation.
Okay. So the agent does all the heavy lifting. It sets up the transaction, negotiates the bulk price with the supplier's AI, verifies the cross-border shipping routes. But a human CEO, meaning holds the ultimate veto power over the swipe.
Exactly. You just click approve on a notification on your phone before the funds actually move.
Okay, that feels much safer. It's a super-powered executive assistant, not an autonomous CEO taking over your life.
Precisely. Now, think about what this means for the creators we talked about at the very beginning of the deep dive. You have a fashion designer in Johannesburg who wants to sell a custom piece to a buyer in Tokyo. Historically, she faced geographic paywalls, high cross-border banking fees, and absolute currency conversion nightmares.
Right, the legacy systems actively worked against her, but now
She uses a platform that integrates Stripe's Agentic Commerce. Her AI agent instantly negotiates the transaction with the Tokyo buyer's AI agent. They apply adaptive pricing so the buyer sees the cost in yen, while the seller receives stablecoins pegged to the dollar, and it settles instantly with near zero fees.
That is incredible.
It is. This protocol empowers global creators to seamlessly bypass the traditional geographic and legacy banking barriers that kept them out of the stadium in the first place.
They aren't just finding a side door, they are building an entirely new digital stadium where the old gatekeepers don't even exist anymore. Bringing this whole journey full circle for you listening. We started by looking at these incredibly talented TikTok creators in Lagos and Nairobi. They are driving global culture, but they hit a massive wall because the legacy monetization systems physically lock them out, based purely on their geography.
Right, which basically forces them to pivot away from passive income and into hardcore entrepreneurship.
Exactly. And because traditional banking wasn't built for them, their local economies leapfrog right into Fintech 2.0. They use USSD text menus, biometric IDs, and AI-driven alternative credit scoring to build total financial independence.
And in doing so, they inadvertently become the most aggressive, pragmatic adopters of AI in the entire world.
It is so fascinating, and that mass adoption converges perfectly with the deployment of this new invisible AI infrastructure, like Stripe's machine payments protocol. So now these creators aren't just selling cross-border, they are plugging into an autonomous economy where AI agents use stablecoins to facilitate instant, frictionless global trade. I mean, it is just a stunning synthesis of culture, necessity, and next-generation technology.
It really is a perfect storm. But, this raises a really important question, sort of a final thought to leave you with, based on where all these sources are collectively pointing. We are rapidly entering a world where AI agents are doing the negotiating, the purchasing, and the supply chain management across borders.
Yeah.
Instantly and flawlessly.
Because, well, they don't sleep, they don't miscalculate exchange rates, and they certainly don't get stuck in bureaucratic red tape.
Exactly. So, what happens when human consumers start preferring to buy literally only from AI agents simply because dealing with human merchants is too slow, too error-prone, or too localized?
Yeah.
Like in a few years, will human-verified commerce become this quirky, expensive luxury label?
Oh, wow.
Right, like buying something that is labeled handmade or artisanal today? Will the ultimate luxury be the actual inefficiency of human interaction?
That is wild. Are we literally going to pay a premium just to have a human mess up our order? That is a really heavy concept to chew on.
Well, thank you for joining us on this deep dive. We really hope it gave you some genuine aha moments and a clearer view of how these massive global shifts actually connect to each other. Keep questioning the evolving digital world around you, and remember, if the venue locks the front door, just build your own stadium.